to share with you. Do you know you can enjoy good income payout by lending your money to reputable companies like DBS, OCBC, and SIA? Something like lending money to the Singapore government, and they give us some interest in returns. In addition, you can also make good return from your capital by investing in bonds. Bonds maturities allows you to control exactly when your capitals come back. Have full control of your cash flow with certainty. Nobody tell us why. Where can we find these bonds? Do you need to have a lot of money? You can now find out the current prices of bonds available on the market through a secret portals that your banker doesn't want you to know. Join us as we unfold the complexity of bond on how you too can gain access to bonds and benefit from it. To start off, what does this mean to you? If you are younger and just getting started, you don't actually need a huge cash outlay. With a small investment in bond, you can aim for passive income to pay for your monthly expenses for Spotify or mobile phone. As your investment grows, you can use the passive income for the bigger expenses like your insurance premium, utility bills, or cost of petrol. Eventually, when you retire, the income from your bond investment can form part of your retirement income as well. The income from this bond investment are generally considered safer and can provide some stability in your retirement income. So for investors who are risk averse, this can be an important factor to consider when creating your investment portfolio.
Okay, so what is a bond? Have you heard about government bond and corporate bond before? Today, if a government or corporation needs to raise capital, needs money, what would they do? One way they do is to issue a loan with fixed tenure, which known as bond. As investor, when you buy the bond, makes you the lender. If you lend money to a government or corporation, you will want some benefits like interest payment, right? So when a bond pays interest to you, it will also known as coupon. At the end of the bond tenure, investor will get back the borrowed amount, also known as face value, par value, or principal. Let's look at an example. On 1st January 2015, Sam purchased a bond from corporation of 1 million at coupon rate of 6% per annum. In this case, 60,000 yearly from the corporation every year until maturity. At maturity, the corporation will pay Sam back the face value, which is the principal. So we talk about coupon rate, which is the interest rate will be paid by the bond issuer. What is a yield rate? A bond yield rate is the amount of the return an investor will realize on a bond calculated by dividing its face value by the amount of interest it pays. Let's look at an example. Today I buy a bond using $1,000. It will tell me the upfront what the coupon rate is. Let's say it's 4% per annum. It means that I will get $1,000 times 4%, which is $40 interest yearly by holding on the bond. The yield rate of the bond is equal to the interest amount divided by the face value, which is $40 divided by 1,000, which is 4%. However, when bond prices change, the yield also change for the new bond buyers at the point of time. Assuming now the same bond, the price went down to $800. The yield rate will now become $40 divided by $800, equivalent to 5%. If the bond prices go up to $1,200, the yield will now become 40 divided by 1,200, equivalent to 3.33%. In general, if you buy a bond at lower price, the yield will be higher. If you buy a bond at higher price, the yield will be lower. So bond yield changes when bond price change. Then why does bond price change? In general, bond prices are affected by demand and supply. Let's look at an example. If today I invest $1,000 to buy a bond, that will give me $40 a year. I call it bond 1. And tomorrow, the same company issue a new bond with the same tenure, give me $50 for the same $1,000 I invested. Naturally, I will want to sell bond 1 and purchase bond 2, which give me more interest, right? So when a lot of people start to sell bond 1 and buy bond 2, it might cause bond 1 price to drop and bond 2 price to rise. Generally, bonds are considered less risky due to less volatility compared to stocks. Often, investors use it as a more stable instrument to balance their investment portfolio. Let's look at a comparison between SP 500 index and SP 500 bond index. In the equity market, from end of April 2008 to end of February 2009, SP 500 index dropped about 47%. From end of Jan 2020 to late March 2020, SP 500 dropped about 30%. In contrast, for the same period SP 500 bond index, it went up about 10% and 7% respectively, which illustrated a negative correlation to equity. Means bond can potentially help to reduce your risk exposure in equity during crisis time. Instead of having 100% stock portfolio, you can build up a balanced one by adding some bonds which tend to generate more stable returns for you.
You've heard that there was some mention of government bonds as well as corporate bonds. So what's the difference? So let us share a little bit more details with you on that. So one of the first segment is on what we call developed sovereign bonds. This usually refers to government issued bonds from countries that generally has high levels of economic stability. These bonds are usually accorded some of the highest credit ratings from the 3 main credit rating agencies that you've probably heard of: S&P, Moody's, as well as Fitch. What kind of returns can you expect from this category of bonds? Usually one of the lowest yields compared to other bond segments that you would hear of later on. Just to give you a bit of an example, the US 10-year Treasury yield as of 2nd of November 2021 gives you a yield of around about 1.57%, whereas the 5-year Singapore Government Bond will give you a yield of around 1.42%. Are there risks that you should be aware of? Generally, these are free from what we call default or credit risk, but interest rates will still have an impact on these bond prices, especially for those with long maturity periods. These are also suitable for investors who want lowest risk bonds as fixed deposit alternatives that can provide a source of stable income. The second category is what we call quasi-sovereign bonds. Quasi-sovereign entities are those that have the support of governments, like government agencies such as the Singapore Housing Development Board and one of the country's sovereign funds or wealth funds such as Temasek Holdings or Hong Kong's Kowloon Canton Railway Corporation. Now, what kind of returns can you expect from this segment of bonds? Generally also categorized by low yields similar to their sovereign counterparts. As an example, HDB offers a bond with a coupon rate of about 2.164%. Are there risks that you should be mindful of as well for this category? Generally, these are free from default credit risk. Take note, bonds with long maturity periods, interest rates will still have an impact on their bond prices. These are suitable for investors who also want lower risk bonds that can offer marginally higher yields compared to the government bonds.
Now that you heard about government-related bonds, let's look at corporate bonds. Corporate bonds also generally have 2 broad categories, which is namely investment grade and non-investment grade. So investment grade bonds tend to have a credit rating of AAA all the way to BBB- according to the S&P rating scale. And non-investment grade bond has a BB plus rating and below. That's also known as the high yield bond. So investment grade bond tend to be issued by company with strong financial standings. That also means that they have a better ability to fulfill their debt obligations. Here are some examples of investment grade bonds. Mapletree Industrial Trust 3.58%, maturing on the 26th of March 2029. Keppel Corporation 3.66%, maturing on the 7th of May 2029. So what are some of the risks that we should look out for when looking at such bonds? As opposed to sovereign bonds as well as quasi-sovereign bonds, credit risk is something that we should look out for, which means we should be looking at bonds issued by company with strong financial standing, That also improve their ability to fulfill their debt obligations. Investment grade bonds are suitable for investors who like to take on some form of credit risk in return for a higher return. Let's take a look at non-investment grade bonds. So non-investment grade bonds are issued by companies with slightly less creditworthiness as compared to those companies with very strong financial positions. Let's look at some examples. Standard Chartered 5.375 coupon perpetual bond, as well as SocGen 6.125% coupon perpetual bond. Given the slightly lower creditworthiness of these issuers, so the bond price also tend to fluctuate a little bit more as compared to your investment grade bond as well as sovereign bond. And as for all bond investor, interest rate risk is something that we should look out for. What does that mean? For example, when interest rate environment is at 0.5%, an investment grade company issuing a 10-year bond, let's call it bond A, might have a coupon of 3%. When the interest rate environment increases to 1%, the same investment grade company issuing a new 10-year bond, let's call that bond B, might have a coupon of 3.5%. And investors holding bond A might sell off and buy the newly issued bond B for a higher yield until both bonds reach the yield of equilibrium, maybe approximately around 3.2% to 3.3%. So what does it mean? It means that the prices of bond A have to be lower to achieve the equilibrium yield, and bond B prices will have to be higher to achieve the equilibrium yield. Therefore, interest rate environments will cause the bond prices to fluctuate.
Now that you've been introduced to the different types of bonds, which one do you think is more suitable for you? Is it the first type, developed sovereign bonds, which comes with low risks and low returns? Or is it the second type, quasi-sovereign bonds with low risks and with low to moderate returns? Could it be the third type, investment-grade corporate bonds with low to moderate risks and comes with low to moderate returns? Or is it the fourth type, non-investment grade corporate bonds, which comes with moderate to high risks and similarly with moderate to high returns? Or number 5, bonds is not your cup of tea at the moment.
Right, now that you know you are game for it, right? So how do you do it? Okay, first, how do you purchase a wholesale corporate bond? Okay, the corporate bond is basically sold at one lot size of 250,000 Sing dollar or USD 200k. Right, corporate bond is transacted over the counter. Unlike stocks, they are not on the exchange. Okay, iFast offers primary and secondary markets bond for investors. Right, now we're going to reveal you the secret from iFast. And what is that? Our bond supermarket. Okay, bondsupermart.com is really the market exchange for bonds. You are able to find your desired bond with some criteria. For example, the currency that you want to invest in. Okay, you can also find how much fixed income you want to take, the coupons. You can also use the maturity, how long you want to hold the investment. You can also look at how much return you want every year, the yield. Okay, so all these criteria will allow you to select a bond that you want to pursue. Okay, after you selected that, you can basically connect with iFast. They will help you to do it. Okay, secondly, iFast is quite unique. Exclusive to iFast is the Bond Express. Okay, for accredited investor or individuals, iFast Bond Express allows investor to purchase as low as only $5,000, instead of the 250,000 per lot size. What does it mean? You can have 50 bonds instead of one for 250k of investment. Isn't that wonderful, right? Fantastic, isn't it? But you need to be an accredited investor. So how to be an accredited investor? These are the 3 criteria. Number 1, annual income 300,000 and above. Number 2, financial assets more than 1 million. Number 3, your net personal asset 2 million and above. These are the 3 criteria. Any one of these 3 criteria will give you sufficient ground to be an accredited investor. Hey, I don't have 250,000. Hey, I'm not an accredited investor. So how? Do not despair. We have a solution for you. The bond funds or bond unit trust. Okay, unit trust is low capital, as low as only $1,000. Unit trusts have the flexibility to add on subsequently and allow you to save and invest regularly for as low as $100 OT. Here's how we can help you. At iFast, we differentiate from our competitors by adopting the market price transparency. Typically in the market, when you approach a financial institution to purchase a bond, you are informed of the price of the bond that you pay. What you may not be aware is within this bond price, there are embedded layers of fees. The first layer of fees is charged by the back-end processing team of the financial institution. The second layer of fees is charged by the frontline sales staff. For example, if each layer is charged 1%, you could be paying additional 2% on top of the market price of the bond. At iFast, we are very transparent and upfront. We will let you know the market price of the bond and the processing fee that we charge. For example, if the market price of the bond is 100% and the processing fee, competitive processing fee is 0.75%, the total price of the bond that you pay is 100.75%. We further value add by being the bond broker, selecting the best available market price from the bond market, from all the counterparties. You get to have the best price, and you know what? The saving from this cheaper price of the bond will give you a few $1,000s. If you're keen and excited about this, stay tuned.
Here's how to start. Scan the QR code to register your expression of interest so that you can connect with us. What are the attractive benefits and bonuses? We are giving away 50% bonus rebate. And this is applicable for all trades within the first 3 months. And this is for all bonds and for all unit trusts. Connect with us now.